The time has come for policy to adjust.
How long did it take? 2 weeks? The market is back to all-time highs. The number one question that I'm getting without fail, should I sell my stocks? Are you going to sell your stocks when the Fed cuts rates? Well, hold on for a minute. Hold on. Let's slow down for a second, okay? What happened recently? Let's go over it. The title of this tweet is what can happen in the stock market for the rest of August 8th. If CPI comes in at 2 point something, we'll rip like no tomorrow. If a slightly higher unemployment spurred recession fears, imagine what a 2 point something CPI will do. Jackson Hole, which was the last time that Jerome Powell spoke, last Friday, as of the time of this recording, August 23rd. Jerome Powell will treat this like an FOMC meeting. He'll have the benefit of CPI data, which, surprise, surprise, did come in at 2.9%. If CPI is favorable at 2 point something percent, he'll likely start drumming up the soft landing narrative. If these two things happen, I think we rip into September, October. Lo and behold, we ripped. We're 0.5% away from all-time highs. It took all but 2 weeks to dispel all of this panic. But we also know the last two rate cuts have been absolute mayhem for the stock market. The rate cut in 2007 on September 18th, the market dropped 57% thereafter. The rate cut on January 3rd, 2001, the market dropped 43% thereafter. Our first rate cut is expected September 18, 2024. I'll tell you in a second how I know that's the case. What is going to happen here? Am I going to be selling my stock? This is by far the number one question that I get. The second most popular question I get is, why didn't you record a video on August 5th telling us to buy if you knew? No, you're right. Maybe because I did. Are there opportunities for us here? Because as you guys know, extreme situations usually birth opportunities. Nvidia down 35%. Are you kidding me? Come on, man. Unless you think Nvidia is just a complete scam and what happened was a one-off. What about Amazon? What about Microsoft? What about the Qs? This is why we hold cash, folks. This is exactly why we hold cash. These are the times we want to deploy. And with that said, my portfolio hit another all-time high. And yes, I did send out all of my trades. I went live with the trading floor on August 5th, sent out everything that I was buying from the triple Qs to Nvidia, etc. I put my money where my mouth is. But anyway, that's not why you're here. You're here because you want the answer to whether it is a good idea to sell when the Fed cuts rates. Because let's be honest, the last two major Fed rate cuts did not bode well for the markets with 40 to 50% drops thereafter. So, am I going to be selling my stock after the Fed cuts rates? Is this time different? Let's dive into the data. And first, here's what Jerome Powell had to say about rate cuts. Let's get right into it. Since we started hiking rates in March of 2022, we've never heard Jerome Powell come out and say flatly, the time is now for policy to adjust. But that is exactly what I was expecting. Jackson Hole, August 23rd. He'll have the benefit of CPI data. If CPI is favorable, he'll likely start drumming up the soft landing narrative again.
There is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
So there you go. That's the exact definition of a soft landing. So is the Fed going to achieve a soft landing? Now, we've never actually experienced a soft landing, but as I told you before, if you guys remember the bank failures of 2023 last year, March, I think it was like around March of 2023 when we had all those banks failing, Silicon Valley, First Republic, etc. That was, in my view, supposed to be the Black Swan event. That was supposed to be the event that caused a crack in the system beneath the pressures of the insane rate hikes, right? So what happened was the Fed and the Treasury backstopped all deposits and made sure that no deposits were lost and that the big banks swallowed up the little banks. Big bank take little bank. And I found this super important data that contradicts what we saw in 2001 and 2007 and the general idea that the market tanks every time the Fed cuts. If you look here, actually, what this shows is that the market rallies most of the time that the Fed cuts, and that 2001 and 2007 were anomalies. Now, are they anomalies? Now, here's where the data can help us a little bit. When I was digging through this, I found that a lot of the same markers that exist today, right, whether it's the inverted yield curves, inflation, etc., a lot of these things were present before, right? So why did the market drop precipitously in 2001 and 2007? But not during these other times after a rate cut? Well, the answer that I found, and the answer that causes the most, or that is the most logical in my view, has to do with stock market valuation. Remember, we are talking about the stock market dropping. We're not necessarily talking about whether a recession will occur. We are talking about the stock market dropping after a rate cut. So in this case, I'm going to look at stock market data, right? I have no doubt that we are going to hit a recession, or that, as most recessions, it will be told later, right? It will be told after the fact, retrospectively. They usually tell us that, hey, you remember that time last year when employment spiked a little bit? Yeah, we were actually in a recession, right? I have no doubt in my mind that's going to happen. You already saw the revisions that showed that the jobs numbers were overestimated by 812,000 jobs or something like that, right? But if you take a look at 2000 and you take a look at 2007, the stock market valuations, if you look at the PE ratio, the stock market valuations were insane. Now, we are not seeing that now. As a matter of fact, one of the silver linings here is that our earnings are actually good, right? So far, the S&P 500 earnings, the Mag 7 earnings, the earnings actually are coming out great. Guidance is not too soft, right? But if you look at 2001, if you look at 2007, 2008, the PE ratio of the S&P 500 was so high compared to now. And as a matter of fact, right now, we are not even as high, anywhere close to as high as it was during the pandemic. And you might be saying to yourself, well, yeah, that is the historical PE ratio, meaning, of course, the PE ratio is going to be so high after the stock market tanks. Well, here's the forward PE ratio, the one that foretells what the price earnings is going to be based on historical data. You can see here that in the beginning of 2008, we were significantly higher, almost 30, compared to the PE ratio that we're at now, which is actually average. The forward PE ratio is actually averaged at 21.8. Now, as of the time of this recording, we still have NVIDIA earnings, right, on the 28th of August. Right now, I'm recording this on the 25th of August. So we still have NVIDIA earnings on the 28th of August. However, if we take a look at the last 3 years of earnings, you'll see that NVIDIA actually does not beat the expected move most of the time, meaning most of the time its move for earnings is actually muted. And when it has beat the expected move, the last 4 times has actually been in the green. Now, I have no way of telling whether NVIDIA is going to beat earnings, right? But to me, I mean, this was a screaming buy below the 100-day moving average, 35% down, probably one of the easiest buys I've ever made, but that's neither here nor there. Most of the S&P 500 stocks have actually not disappointed on earnings. So there's no reason for me to believe that NVIDIA on its own is going to tank the market. So we know from a stock valuation perspective, this is not the same as 2001 or 2007, right? So what other things do we have to look at? I showed this to you before, but this is the high yield index. This is high yield bonds, junk bonds basically, compared to safe bonds, right? More risk averse bonds, which are usually government bonds. So if you look at this, the high yield index, the higher this goes, the worse it is, by the way. It means that the more risky it is, the closer we are to something breaking. Look how flat we are here, right? And look at what happened in 2007 as the Fed cut rates, right? This started rising sharply before we hit a recession. Same thing in 2001. This started rising sharply before we hit a recession. We don't see that here. We don't see the high yield index climbing in a rapid fashion. It's actually pretty flat here. The two things that I'm going to be watching like a hawk before the rate cut in September 18th, which they are going to cut rates. We'll talk about the rate cut expectations in a second. Is it going to be 25 basis points or 50? But the one thing that I'll be watching like a hawk is the next unemployment, right? So if the next unemployment comes in at 4.5% or greater, the last one came in at 4.3, it was expected at 4.1. If the next one comes in significantly higher than 4.3, and the next CPI, which is September 11th, comes in above 2.9%, so it's back above 3%, then I will start to get worried. But in terms of what the market is expecting, right now, the market is expecting 100% that the Fed is going to cut. There's no other way. It's just, does it cut 25 basis points or 50 basis points? And this is the highest bet that we've ever seen for 50 basis points for the September 18th meeting, right? Almost 37% bets on 50 basis points. So as of right now, as it stands, what I think is going to happen is that I think that the market, if we don't get a scare in unemployment and it comes in significantly higher than 4.3%, and we don't get a scare in inflation that comes in significantly above 3%, in other words, regressing, going the other way, then I think that the market can actually continue ripping even after the first rate cut. It can continue ripping for a little bit even after the first rate cut into the election, right? And then after the election, obviously, I will start compiling the data that we have up until then. And maybe by December, January, start looking at potentially selling my stocks. But here's the thing. Everyone's position is different. I get this question all the time. Should I sell my stocks? I don't know who the hell you are. Are you close to 70? Did you start buying stocks 40 years ago? Are you a 22-year-old who started buying stocks last week? Everyone has a different profile, right? And the less time that you have to retire, the less appetite for risk that you have, right? And it's my belief that bond funds such as TLT, bond funds such as TMF, even though I'm not a huge fan of holding leverage ETFs, but we're not even going to talk about that in this video. But bonds in general, whether we're talking about treasuries or bond ETFs or bond mutual funds, I think we'll have double-digit returns in 2025 and 2026 because as bond yields drop, this is when you start to get bond prices rally. Now, I also did this analysis in the trading floor, and I showed you here that after the Fed rate cut, we actually saw a drop in bonds and a very small spike in yields, right? Before bonds, before TLT, I think this is TLT, yeah. Before TLT actually rallied for 42% after the first rate cut, right? So the bond market is a market just like anything else. So after the Fed cuts rates, that's obviously something that was priced in. You're going to see a sell the news sort of effect. And that also happens in bonds. You're going to see a sell the news sort of effect right before the realization kicks in that, hey, bonds are likely going to increase for years to come if the Fed keeps on cutting rates. So in my view, if you're a more risk averse person, this is not financial advice, but you definitely want to be thinking about what to do with stocks when the Fed cuts, right? Are you going to trim? Are you going to sell all? Are you going to rotate into bonds? In my view, cash is worthless. I think that there is a huge opportunity in bonds, and I will likely start increasing my bond allocation as opposed to just going cash. I rarely ever go all cash anyway. You know, it's usually some type of asset, and I do think that there is a generational opportunity in bonds. But based on the stock market valuations and the differences that I see between 2007, 2001, and now, where we don't have those extreme stock market valuations now, most companies can justify their earnings. I do think that we will see the typical rip into the election, and then you tend to see a slowdown after the election. And obviously, depending on unemployment and CPI, if that stuff comes in higher than expected, and it looks like the market is starting to break or the economy is starting to break, then yes, I mean, in my view, I will likely be getting out of the market with my short-term and mid-term positions. I've been investing for 20 years, right? So if I bought Apple at $25, you can't expect me to then say, you know what, fuck it, I'm just going to sell everything, let Apple go, the $25 Apple, let it go. No, obviously, there are some stuff that I will hold on to. Plus, it's also a tax implication here in the US, right? So that's something that I have to think about as well. I have to weigh it with, in the sum of my risk, I have to weigh the tax implication of selling some of that much longer term stuff. So some of the things that I bought recently, I might start trimming, right? But the really, really, really long-term holds, no. I mean, if I've held something since 2008, I don't have an incentive to sell and take that tax hit. So I would appreciate if you guys stop asking me, should I sell? Are you going to sell? What are you going to do? This video should give you everything that you need to equip yourself to make a decision based on your profile, your tax profile, your risk profile, your age, time to retire, your risk appetite, what you hold, etc. I can only guide you so much. And so far, I'm happy to say that we've been mostly right this whole time, right? I told you that I'm expecting in October 2023, that will likely be the bottom of the correction. I told you that in April, that is likely a routine pullback. I told you that August 5th reminds me of August 24th, 2015, and that I will be buying the bottom of the, Japan flash crash. And now I'm saying so far the stock valuations don't look like 01 and 07. We will likely see some sort of small sell the news event after the rate cuts. But unless we get a spike in unemployment or a spike in inflation, I think the market can continue rallying for a bit until at least the election, which is on November 4th. Anyway, traders, hope you got something out of this video. Let me know in the comment section below. What are you going to do? I'm curious to hear the array of decisions that I see you guys talk about. If you want to trade live with me every day, day we trade futures live every single day. I trade, I share my screen, and I show you what I'm trading. If you want to get access to all of my real-time buys, subscribe to the trading floor down below. It's a description down in the description down below. Make sure that you join before September 1st. If you're watching this before September 1st, make sure that you join the free trading webinar that I'm going to be teaching on September 1st at 12 p.m. Eastern. That link is also in the description. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.